Good morning and welcome back to Almus Market Mornings. It's really a tale of two currencies. For change, I don't want to start our podcast with the usual geopolitics or AI related updates, but some interesting things coming out of China. Broadly, when we look at China, outside their tech, their economy seems to be more or less stagnant. Real estate prices have been in a slump. Consumption is not propping up. Retail sales was disappointing. But somewhere, the advanced manufacturing is helping mask all this weakness in other sectors. In fact, there's substantial inflows being witnessed into China. Central bank's reserve assets saw its biggest quarterly rise in 12 years. The balance of payment recorded an inflow of almost $72 billion in the second quarter, and it has coincided with the sixth straight quarterly gain for yuan. The Chinese yuan also trades at levels seen in 2023, and from our understanding, even authorities are setting the fixing stronger. Let's understand this from JK. Good morning, sir. So, yuan, we haven't touched upon in some time. Before we discuss the new updates, what are your 2 cents on the moves being seen?
Good morning, Swaraj. It's actually not tale of two currencies, it's tale of three currencies, the yuan, yen, and the rupee. So, the very notable moves in these currencies. Of course, it's not about the extent of the moves that is important, it's the direction of the moves that is important. And as you pointed out, the domestic macro data by China published yesterday showed a very weak, setup, and it really is a very skewed performance of China on the external front, and on the domestic front, they are performing very weakly, as shown by weaker than expected industrial production, retail sales, fixed asset investment. Even the unemployment rate inched up from 5% to 5.2%. And housing sector, as we all know, is still very far from recovery. The only silver lining, particularly in the industrial production, was that the manufacturing continued to perform, well, growing at 5.5%, because of high-tech manufacturing, and also the export related productions, which helped the number to be slightly held up. Otherwise, it is, Chinese exports have been one of the important buffers against the weak domestic demand. And while households are cautious and properties are depressed and private investment is contracting, manufacturing capacity has increasingly been directed towards external markets. So while that has helped a large inflows into the forex, because for example, last July, in the month of July, the export surplus, or rather the trade surplus, was $112 billion, and before that in June it was $125 billion. Very large numbers, and even if the uh, central bank wanted to stop the yuan from appreciating, it would have been very difficult. It is commendable that they've been able to keep it stable, not appreciating too high, which means they are building the huge amount of reserves also. So that is the situation in China. But if you look at, on the other hand, the yen, Japanese economy, economy is doing very, very modestly. No major sector that has done very well. Yesterday's GDP growth was also disappointing, coming lower than expected. And the consumption there has not picked up despite the various fiscal measures that they have provided. And the Japanese yen weakness is actually adding further to the inflation and affecting consumption as well. The efforts of the Japanese central bank and the government has been directed towards the improving consumption, and even at the cost of weakening yen, they kept the interest rates low, although the real interest rate there is deeply in the negative. And that is where the intervention has actually failed. So they are not able to stem the weakness of the yen sustainably, although it is trading definitely well below the peak seen this year. It is not coming off, and it is holding somewhere near 160. And the fear is that if there is no further action, having already seen joint action from US and Japan, it will continue to weaken, mainly on fiscal concerns, lower growth. And on the external front, Japan is doing relatively okay, but not as well as China, not definitely not as much as to make up for the domestic weakness. So that is a situation of the yen, which continues to weaken despite the efforts of the government and the Bank of Japan. If you come to rupee, it's in a very peculiar position. The exchange rate, just like Japan and China, it is also undervalued, but not to the same extent. So, I would go by RER. It's about 10% undervalued. And again, here, the government and RBI have been very keen to stop the depreciation of the rupee, which has been weakening ever since late 2024, and there have been large outflows which have been seen, and BOP, was tending to be on the negative, and then of course we had the well-known efforts from government and RBI to bring in more capital flows, which have helped, of course, to bring in capital flows. Again, the latest decision from RBI to bring forward the closure of the FCNR scheme has been taken somewhat negatively by the market. They fear that while this serves to add to the current buffers of RBI, there will be no net overall increase in the RBI reserves, because it is also creating a forward liability to the same extent for RBI. Therefore, market still feels the rupee is not really benefiting in the long run due to these efforts, and it is only a stopgap measure which authorities are expected to use for bringing in reforms and policy moves which can improve sustainable capital flows. In other words, what I mean is there should be more FDI flows, there should be more long-term investments by the investors, FIs, to equities and bonds as well. But that is not, at least so far, not so much visible, although we have seen some modest flows in the bonds. So that is the situation of rupee, which of course historically has always been a weakening currency, but in the last 2 years the weakness has been much more pronounced, and what more than what the authorities like, and has taken the rupee to the undervalued zone. So that is where the authorities also. So this is a situation of three important currencies which are as we referred in the morning. I think we should be watching these currencies, what happens. All this is happening even as the dollar index is weakening, which is reflected in the strength in the euro and in the GBP, as well as in the commodity currencies. And gold has been once again above 4,400 mark, ignoring the rise in oil price. No, while we have spoken about the yen, yuan, and the rupee, the geopolitics has not been in such a way that it can be ignored. We have the 60-day ceasefire agreement between the US and Iran that ended, and Iran said that it will escalate tensions in the region if diplomacy fails with the US. And the report also said that Iran decided to shift its policy from defensive to fully offensive, and will not wait for US to continue to do the naval blockade indefinitely, with a time frame that will be set by Iran and conveyed to US and regional mediators as well. On the other hand, Trump said Iran would not make the type of deal with the US that he thought was necessary, and indirectly he's also threatened Oman, which has not been cooperating in terms of achieving the mediation efforts. So there are reports of attacks as well in the Saudi region and on the ships passing through the Hormuz Strait. And significantly, why all this matters to the market is that oil is once again pushed above 90, and then yields in the US, which is of course the and what we all the whole of the world follows, has been on the rise once again. 30-year yield is now above the level seen in 2007. 10-year yield is slowly and steadily marching towards 5% once again. It was last seen in 2024. And of course, the short term is holding up because the rate hike prospection September has been reduced. In other words, we have a severe bear steepening of the yields, which is very, very significant. And what you should also note is that we had a host of weak economic data from US, starting with job numbers, and then, of course, the softer inflation numbers. We had consumption just one week by the retail sales, and also the consumer sentiment was poor. In spite of all this, the yields have been going up. So market's concern is not on the cyclical economic data, but it's more on the structural issue of fiscal deficit and the debt servicing, as well as the oil price, which is continuously going up and not really giving any comfort to the government in terms of managing the inflation as well as consumption. So we are in a very tricky situation for the global market, and of course for the rupee as well, which is broken 95 to technical level and slowly marching towards 96 test, which I think will come sooner or later. Thank you.
Thank you, JK. And yes, we discussed the three currencies, yuan, yen, and the rupee, and the different kind of directional moves we are seeing over there. Large surpluses on the trade front and the BOP front, keeping yuan on the stronger side. Meanwhile, when it comes to Japanese yen, they are way behind the curve when it comes to the actual rates that should be in place given the inflation that's prevailing in the economy, and that's keeping yen on the weaker side. And on the rupee, we are having that depreciation pressure once again, as the government has taken the FCNRP, has decided to close down the FCNRP deposit facility pretty early. So three currencies and three different themes which are playing out. And of course, geopolitically, things remain uncertain. Oil prices are above $90 a barrel. Yields in the US have been on the rise. The 30-year US yield is above levels seen in 2007. So bear steepening is going on. More or less, things remain uncertain, and that's what the key takeaway is. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.